Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and answer any questions you might have. Talk about recent trades as well. For those of you who are new, welcome. This is my brief bio. We have few new people, so if you're new, please type in first. But this is my background. My background is technology, building software for hedge funds, for broker dealers, retail platform, options platform, for trading analytics. So that's my passion and background. Some of the companies I worked for went public, so I decided, okay, I'm going to take my money and start managing myself, build a team of financial engineers that provide models, create new models, optimize models, and then I trade them in a live trading room. And recently, Keith joined me, who is used to be a market maker on the floor, on electronic market making. So he brings that perspective from hedge fund and professional trader, which is great. And I think it's a nice addition to the team. Disclosure, very important. Please read them. Trading stock and options involve risk and not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. If this is your first time you've seen these disclosures, I encourage you to visit the link. Most of you have seen it many times, but some of you never seen it. So if you've never seen it, please visit this link, optionscreener.com, so you can understand the risk, the suitability. That is very important. And then you can pause the screen to read the remaining of the disclosures. All right, before we jump into a trading plan, let's go over current market conditions and see what to expect going into the end of the year and beyond. So let's look at spiders, right? We are flat for today. Semis are leading up 2% after Broadcom earnings. QQQ is up close to 1%. It continues to make new all-time high. So you definitely have short-term rotation out of the cyclicals, right? Cyclicals led all the way till end of November. And then they gave up the leadership to technology end of November, right? And people are rotating out of the value stocks into technology. We've seen this trade before. We've seen this movie before. Usually this lasts certain period of time. It could be, weeks, it could be months. But at some point, it converges back and, and then you have, the consensus has been that the value outperforming technology. We'll see. We'll see if that's the case in 2025. But for now, that is the case. So if you look at this stock forecast toolbox for spiders, right, one of our main models. So let's talk about short-term, long-term. So for 10 days, it basically sees support at overhead resistance, somewhere around 610, 612. If you look at the positioning data for options and future data, there's a lot of open interest at 610, 615. On the downside, 593, right? If you superimpose this chart with, let's look at gamma exposure. If you superimpose the data with gamma exposure, not Broadcom, spiders. That you can see first overhead resistance again is at 610 and then 615. So that's all-time high, pretty large open interest now at this 610 level. We do have next position is 615. So CPI data, PPI data came in. CPI I think came in, from what at least I understand, within expectation. PPI maybe a little bit harder. Interest rates are going higher. That's the bottom line. Interest rates are going higher. So that's the overhead resistance. If you look at what the market thinks is going to happen till, well, that's next week, right? Expiration is next week. Yeah, so fine. So let's do December expiration, right, and January expiration, just that. So then you see that basically 615 strike is where the high open interest, and that's one standard deviation move, right? So between now and January 17, third Friday of January, this is the overhead resistance. 1 standard deviation to the upside, assuming everything is good. We're going into the earnings season, people are excited, and January from seasonality point of view is also, I think, strong months. Right, let's look at Spider's seasonality. It's not bad, right? I mean, we've seen drawdowns 5%, 4%, obviously. But after the election 2017, 2018, pretty strong months from seasonality point of view. That doesn't mean it's going to happen, but from seasonality point of view. So that's Spiders. And on the downside, right, if there's any negative news, somewhere between 600 and 595. I mean, there's some positioning at 600, right? Gamma. So you do have $1 billion, no, $1.5 billion, $1.5 billion of gamma at 600, and then another billion and 0.2 at 595. So pretty well positioned for Spiders to basically trade in the range going into the January. 595, right? That's the gap, this gap. And it will be 50-day moving average. So somewhere between 595 and 615. This is what to expect going into the end of the year and maybe the 15th of January. If you zoom out, and we already have Goldman Sachs, RBC basically making projections for the stock market for next year. And I think the theme is, it's the second year, it's going to be the third year of a bull market that, we've been up 20% last year, up over 20% this year. Most people don't expect another 20% up next year, but they do expect at least 10% up next year, right? I agree. I agree with Goldman that we could be up 10% next year, but the consensus is also going to be volatile, right? We're going to have these 5, 10, 15% drawdown, maybe not as often as we had in 23, but maybe as often as we had in 24. So if you zoom out to 6 months, still strong in uptrend. Model basically says the same thing. Expect in the next 6 months up another 12%, right? That's what the model says. Not as strong of momentum as before, but still shows that, if we see 700 between now and June, I would not be surprised. Right? So the long-term bullish trend is intact. We probably will have drawdowns, but it's a pattern of higher highs and higher lows. So that's a bull argument if you're bullish. If you're bearish, basically you're saying, listen, interest rates are elevated, right? We touched 450 once, we touched 450 second time. Looks like we're approaching 450 again third time. And if we break above that, that means that the new administration is going to be, pro-tariffs. That will create inflationary pressures, and inflation is going to come back up, right? So that's a bear argument. Or unemployment has been cooling in 2024, and that cooling could accelerate in 2025. If we drop, let's say, below 3.6, then there could be signs of, the bull market is, sliding into, bear market and recession. So that's the bear argument. Semiconductors have been underperforming, right? Bulls are concerned, bears are. That's another argument, right? We're trading in a downtrend. We're been testing 200-day moving average throughout December and November. Why? 23, 24 have been led by, up until July, it was led by, semiconductors. So why is it lagging now? I mean, it's a good question. It's a good question, especially with AI theme. AI need semiconductors. You can't get too far without semiconductors. So we'll see. Maybe because now Amazon and Google are competing and they have their own chips. Maybe this is the reason. Maybe because new administration is pro-tariffs, and they're going to maybe control where NVIDIA is going to sell their chips and to who and how much. I mean, both valid, both points need to be considered, but that would be a bearish argument, right? That we're too far for too long. Market, evaluations are stretched. S&P evaluations are stretched, and unless we have a spur in growth and expansion in earnings momentum, then this rally is in jeopardy. Okay, valid arguments. Can't really argue against them. So that's great, but what do we do, right? So let's talk about January, right? Most of us are kind of short-term to medium-term traders. Long-term traders, okay, you're just buying dips. Every time you see 5 to 10% correction, you're buying the dips, assuming you're a bull. And assuming you're a bear, if you're up 10, 15% next year, then I guess you sell short. Or if you see that the market is losing momentum and can't break through, then maybe you press to the downside. But for now, bull market, this bullish momentum is intact, right, for now, since August. And even since, 2020, November of 23, right? This line is still intact. Yeah, bulls will argue that as long as we're above 560, you have nothing to worry about. If we drop below 540, well, most bulls will probably argue 520. So as long as we're above 510, right, that April lows, August lows of last year, as long as we're above August lows, the bull trend is intact, right? And you have nothing to worry about. If we drop below that line, that it means that this bullish momentum is probably rolling over. But until then, that's the consensus. So going into January, well, we said one standard deviation, right? 50-day moving average somewhere around 595. So let's just use this line, 585, 595. So that's one, and overhead resistance is around 615, we said 620. All right, so let's call it 615, 620. To the upside, all right, maybe 20 points to the upside and maybe 20 points to the downside, right? 580, I would call it 585, 590. All right, we're talking about third Friday of January and end of this year. So scenario number one, earnings in January is going to accelerate, right? We're going to have a strong earnings season, and new administration, not going to say anything about, definitive interest rate. They're going to keep negotiating with all these countries. That takes time. And we have scenario number one where we're above 615, 620, right? We're 10% up well, by January, probably you can't have 10% up, but more than 2% up, right? Like 4% up, 5% up in January. All right, so that's scenario number one. Scenario number two, we're trading in the range, so it's somewhere between 615 and 590. And scenario number three, either the interest rates break through the 4.5, right, and you have a resurgence of inflationary data. I mean, you probably need a couple prints for that. So January is probably going to be too early, right? But maybe unemployment data in December just took a dive, rising, right? Unemployment rate rising, employment going lower. So okay, so 1, 2, or 3, right? Let's call it end of January. How many of you say 2? Mark, Don, 2. Okay, Andre, 2, Joseph, 3. Okay. So we're talking about end of January, right? Third Friday of January. Strong, Kevin, thank you. I added your commentary into discussion. If you're a bear, then the tariff war is not good, and chips underperforming is not good for the market. I do agree with that. All right, but we have to time it, and timing is difficult, so we have to have an opinion. Okay, so most of you are 2s. Joseph is 3. and Vlad is going with the crowd. Yeah, I'm gonna say 2. I think this chart basically tells you what you can expect, right? You get to 600, 595, I would be a buyer. You get to 615, 620, I would hedge, trim position, sell calls, buy put spread, something that decreases your portfolio delta, right? Some bearish positions. So that's the view on the market. Short term, I think the Goldman Sachs and the model are probably right. I think these are the prints you can expect. I mean, timing is difficult, right? But somewhere between now and December, we will probably see 700, 724 print. Not a straight line. Market never moves in a straight line like model shows here, right? You do have these big drawdowns, but they usually triggered by some kind of events, right? So, but for now, that's what the market sees. What else is interesting? Crude oil underperforming, right? Europe is struggling, China is struggling, crude oil is in downtrend, right? So global economy is not, it's not as rosy as United States. I mean, United S&P 500 derive, large percentage, I don't know, 25, 30% of its revenue from outside of the United States. So, if Germany and France has issues and recession and German manufacturing continues to contract, and that's an issue, right? That's why oil is down. And at some point, it's trading in the range for the most part, but it's still kind of lower lows and lower highs. I mean, if we take out this line 65, that could be also bearish for the market, right? Overall market, because we haven't seen 65 since 22, 23. Right, it's a very long-term support. So that's crude oil. I would keep an eye on that. Bitcoin, proxy for risk taking, risk on, above 100,000. A lot of people projecting 200,000 by end of next year. Okay. Yeah, if S&P is going to be at 7, SPX is going to be at 7,000, Bitcoin is probably going to be at 100,000. So that also makes sense. China has been struggling, right? That's kind of, we had that enthusiasm going into the stimulus, and it looks like we gave up most of those gains already. It's struggling and it's pulling, stocks like copper and, metals in general, pulling together with them to the downside. Consumer staples, healthcare has been underperforming. That's the theme, continues to do that. Silver has been underperforming. That's the theme. Talk about small caps on its way to 50-day moving average. So continues to grind lower. And spiders, with technology continues to outperform. Looks like value is turning positive, and QQQ giving up most of its gains. High yield is pulling back, so I would watch 50-day moving average. Any questions on the chips? I mean, gold has been in strong uptrend, right? If you look at the same chart for gold, and it's still an uptrend. Model does still see that gold continues to be an uptrend. So uptrend is intact. Most people are bullish. I mean, this pullback in gold did break the uptrend, at least short term, right, since the beginning of the year. Dipped below slight. I don't know if it broke, but put it in jeopardy. Right? I mean, if we break, but probably as long as we're above 230, as long as we're above 230, it's a pattern of higher highs and higher lows, especially if there's still concerns about inflation and so I think long-term gold is a buy. Carl, Boeing has been, it's a tough stock to trade, right? It's just kind of a very bearish, extremely oversold. They continue to have bad news. I mean, if you're long-term investing, you say, well, market stocks is not going down anymore in bad news and the worst is over, you can buy it. But, you know, it was the same argument at 190, it was the same argument at 200, right? And it just continues to go lower. So it's the same thing. You can go into the chart and basically say, you know, what's the long-term momentum behind Boeing, right? And it's still negative, right? So as long as that has a strong momentum to the downside, you're trading against the current, right? You're betting that this trend is going to change. You can look at the weekly chart, kind of see that for the past, I don't know, 1, 2, 3, 4 weeks, it's not making new lows. So you can structure your trade. It will be a trade. Just say, okay, if it drops below 140, I'm out, right? 10% to the downside. But you know, it could get to 260. So I think that's good risk versus reward ratio. But you're betting that the trend is changing. And right now, you know, it's too early to assume that the trend is changing, right? Still below 200, still below 50. I would say it needs to get at least above 200 to say, okay, the worst is over, right? But for now, we're still in downtrend. All right, Kevin, thank you. 3 makes sense. Okay, what do we do at Yellow Tunnel that can help you? So we have different services, right? We already talked about seasonality, right? We didn't talk about signals, right? So we have a model that runs every day, that's active trader, every week, weekly trader and monthly trader. And every day or every week, depends on if you're a short-term or long-term trader, you have signals, right? Maybe some energy name, RRC, maybe Palo Alto, we discussed in live trading room, right? I actually closed the Twilio with a signal. So I'm out of Twilio and I was considering, you know, maybe PNW is next. So if you're looking for ideas and signals, we do give you signals. Palo Alto basically says if it's at 400, you can buy it, or look at the predicted low. It's a high beta stock, so it's volatile, right? So you either wait for predicted low or you buy at the yesterday's close. So that would be the entry point. And the idea is not to risk more than 1%, right? So if it's on short-term day trading. So if it's up for 1%, you're out. If it's down 1%, you're out. It does it for all the stocks, right? I kind of group them as 1%, but keep in mind that Palo Alto is high beta stock. So if any QTs also, but you know, you might adjust for beta and say, okay, it's 2%, right? Because Palo Alto can move 2% intraday. But you know, those are your suggested guidelines. I always encourage you to, it's all about risk management and position size. If you're holding position overnight, I would say 2.5% should be at risk. And I would still divide it into entries, right? So you're only risking 1% of your portfolio. If you're doing day trading, I would suggest you risk less than 1% of your portfolio for day trading. Maybe 0.5%. So those are suggested entry points, those are suggested exit points. Similar fashion, if you, okay, I'm not a day trader, I like to hold position for a week, maybe a couple weeks. Then you have weekly trader, right? At Mandel runs every Sunday, you get a list of symbols, Boston Scientific, you know, TJX. You buy at 90, sell at 91, right? Here we're looking for 2.5% move. Same thing with TJX. If it drops to 126, this is when you buy, and you're risking 2.5%. Because these are weekly trades. And if you're not confident, if you want to leverage, obviously you can go to options, or if you want to hedge your position, then we suggest you know, in the money options, either weekly or monthly contracts based on availability. So that would be the models: active trader, weekly trader, monthly trader. The tools, stock forecast toolbox, we talked about that. We talked about seasonal chart, probability calculator. right? You can see probabilities. Oh, the same thing, right? This is looking at the historical volatility, right? This was implied volatility, right? The future. This is the past. But future past volatility is the same, then you can see same results. 590, I would consider buying. 615, I consider selling. You know, based on our model, kind of mixed picture. You know, basically neutral trend based on our predictions. So that would be the tools, right? So you have the tools, stock forecast toolbox, you have research, we have screeners. You can do your own screening, and what else? And then we have services. So if you want to, this is if you're a self-directed investor, you've been trading for a few years, and you're just looking for AI model that gives you valid signals that are tradable, actionable, specific entry, exit, then that's what you do. But then you have to manage your portfolio. You have to enter the trades and exit the trades. Elite Circle is where you can actually see what I do, right? And you can, on daily basis today, let's say I added to Sempra, right? I added a Sempra utility. I closed Twilio yesterday, right? I closed Twilio. I added Amazon. I'm trying to get out of Microsoft spread. So pretty active platform, right? Every week I trade stock and options because we have subscribers that only trade stocks. We have subscribers that trade only options. We have people that trade both. I do try to provide examples for both. Keep that in mind, right? So I'm trying to be comprehensive and use it as education. But when you trade on your own, just keep in mind that you don't want to be average retail investor that just starting, especially the first year, I would say 4 positions, no more than 2.5%. So if I have 8 positions because I'm a little bit more experienced and I'm providing different examples, life examples, that doesn't mean you need to do the same, right? If you're an experienced trader, you want to copy all the trades, some of the trades, totally fine, right? But you do get exposure to these trades, right? This is real-time synchronization, like in live trading room. As soon as I place this trade, you see it. Positions, you see it live, right? What else? You can enter, if you're away from your desk, you can enter your phone number, right? We have Discord messages, so then you would get Discord or SMS message. You can watch the recordings, right? As soon as the live trading room is done, you have your recordings. And what else? And that's Elite Circle, right? So you have all of the trades. If you want to do shadow trading, right, just my trades, same thing. You can just see my trades. If you want to only do spreads, right, this is Microsoft. You can just do premium, right, where you can actually see all of the premium trades. If you're just looking for stocks, you can go to Robo Investor. This is stocks only portfolio. But that's what you can get out of these subscriptions. I encourage you to take a look at them. We do have a YouTube channel. Every Wednesday, there's a live trading room broadcast on YouTube. Please sign up. We have a blog. I encourage you to review our blog. We have one published every Monday, and every Tuesday we have a video. And then RoboStreet, we have 3 blogs, every Thursday. So you have blogs, videos with actionable trade ideas, market overview, some of my personal stuff. So I would encourage you to take a look at that as well. And we do have Learning Center, right? We have a Getting Started guide, and we have a Learning Center, right? You can, if you want to learn about Tradespoon, if you want to learn about technical analysis, advanced technical analysis, options basic, portfolio management, money management, trading plan, we have a lot of videos, advanced options. You can look at these videos. This is free content, right? It's free content, something that's available to you. Any questions? So to just recap, very important, if you're in live trading room, I always reiterate this, very important to have trading plan, right? Trade your plan, right? Write it down, your plan, and keep a journal. Every time you trade, you cross-reference your trade plan, you have a checklist and say, okay, 1, do I have cash? 2, what's my position size, right? Making sure that you're not breaking the position size rule. Structure your trade based on probability of success versus return on capital. Some of the other things that we cover in live trading room here, suggestions for trading plan: 2 to 3 days to confirm trend change. Do not break legs of your spread, right? Be long and short the market at the same time. Right? If market is overbought, then okay, either sell options against your stock or trim your position, raise cash, right? But that would be the approach. Allow more time, allow more space when you trade options. You have to be correct on magnitude of the move. You have to be correct on the timing of the move. And I covered different biases. Any questions? If you start in your journey as a trader, there's some books that I encourage you to read. Right? One is Thinking Fast, Thinking Slow, right, by Daniel Kahneman. When you're trading, very important, that's kind of the theme, right? You're operating in 2 modes, fast and slow. Fast is kind of your feelings, your intuition, your biases, right? You make quick snap decisions and you trade. Thinking slow is more of a cognitive. You're keeping journal, you're writing things down, you go to presentations, and you're very methodical about trading. In trading, I mean, if you're day trader, you probably need both, right? But still, you need to have that balance. So I encourage you to read that book. This is very important. His prospect theory is an important topic, right? Idea is that I don't know why I do this. That our relationship with gains and losses are asymmetrical, right? They're asymmetrical, meaning that when you're faced with a $500 loss or a $500 gain, in theory, if you're ChatGPT or AI model, you treat them the same way, right? You make the same decisions. But as the humans, there is a skew, right? So it's important to be at least aware of that skew, right? And be aware, right? Self-awareness is important. So I encourage you to do that, to read that and try to understand prospect theory. And Thinking Fast, Thinking Slow is probably one of my favorite books. Not Thinking Fast, Thinking in Bets by Amy Duke. All right, she's a PhD in psychology, successful poker player. She doesn't talk about trading, but she talks about poker playing. And there's some analogy, right? And the biggest analogy is that if you're a professional poker player, you approach all your investments or bets in terms of probabilities and odds, right? And sizing. So that's the theme, whether it's in poker or trading. You're trading based on probability, you're trading based on distribution of possible outcomes. And then you take certain side, right? And then you invest in certain amount of money. And as long as you're more right than wrong, or at least you could be right less than wrong, but as long as your gains, proceeds are greater than your, drawdowns, then your portfolio will grow, right? So that's the main theme of this book, and it's very important to read it. Yeah, I think it will be very useful if you haven't done that before. All right, any other questions? Andre, Carl, Don, Horizon Scanner, Joseph, Kevin, Larissa, Mark, Pam, Trader. A lot of traders today. Trader, welcome. We have new people. Anyone new? Type in first if you're new. All right, any other questions? If there are no other questions, thank you very much. I appreciate everybody attending. Thank you. Have a great weekend, and I will see you. We do have a closing bell today, and then live trading room on Monday. Hopefully I can see you in live trading room on Monday. Thank you very much, and have a great day.